All right, time to dive deep into a new subject. Well, it actually is an old subject, but into a new level of detail into an old subject, agency bonds. So we're going to look at them in very different light, and I'll explain more as we go along. We are at 175 subscribers. Thank you. Please use the roadmap, which organizes all of these shows. This is show number 82. So to the extent that you're jumping right here, it may not be the right starting point for you. And then I want to answer the question why we are even diving deeper into agency bonds, and I'm responding to feedback here. What you're seeing here is the number of views of specific videos, and for whatever reason, agency bonds are 3 to 5 times more viewed than any other video, and so I figured I'd go deeper into it just to cater to the statistics I'm getting. A couple of you asked specific questions as well. Thank you for your questions. It helped me learn, so thank you for letting me learn, and I'll share what I learned, and you do your own research and your own decisions are yours to make. My usual disclaimers on that note: this is education. I am sharing what I learned. This is not investment advice. It is not tax advice. You make the decisions, and I'm not a wealth management advisor. And I don't have t-shirts. Nobody's sponsoring me. So let's get to the fun part, agency bonds under a microscope. Quick history, and then we're going to look at how money flows into agency bonds, and there is a very interesting story there. And then we're going to look at Yield Super Bowl and ask the question, why agency bonds now? And we'll look deeper into the next 4 weeks where there are some possible fireworks. Now, what is the background of agency bonds? I would suggest, and I am not going to go through it in any detail at all right now. Agencies were formed in the FDR era to kind of lift the country out of depression, some of which, some agencies date back to 1915. The first Farm Bureau was created then. So having said that, videos 16, 17, and 18 are a great refresher. Video 64 starts spiking a trend saying, hey, something is happening in agency bonds. And I'm going to actually dive deeper and show you why that something is happening. But the original reason agencies were created was to stabilize the country. We're not going to discuss all the kinds of agencies. Please watch video 16 to know more about them. But we're only going to focus on two, the Farm Credit Bureau and the Housing Lending Bureau. Those two are state tax exempt. The rest of the agencies are not. So be careful. Don't buy an agency bond because their credit ratings are high without taking the state tax credit effect into account. Specific to FFCB and FHLB, there are 11 banks around the country that take care of most of the home mortgages. FFCB, there are 4 banks, and some of these bank names you may not even have heard about, and we'll dive deeper and you'll see what they are. All right, so let's follow the money in agency bonds, and we're going to start with FFCB. And if you were to Google farm credit funding, you will end up in this beautiful page. And there is that little link there that says investor resources. And if you click there, you will see an investor presentation link. And the rest of the discussion on farm credit is from their investor presentation, which was released a month ago. So it's an excellent overview of the state of the Farm Credit Bureau. The first thing we'll look at is how money exchanges hands. This is from their presentation. Small people like you and I don't even show up on their map. I think they should have a little circle here that says Yield Nerd viewers, but we're not there, not too big yet. But they say, hey, we have these institutional investors, these people who take their money and they go through dealers. I go through Schwab, you may go through Fidelity, Vanguard, whoever. You may go through other banks, you may buy through Merrill, Bank of America, I don't care. But you go through some of their specific dealers, and then you buy their agency bonds from the Farm Credit Funding Corporation. That is the one that issues the bond. You and I go through a dealer, we buy that. The dealer makes a couple of cents on the dollar. Hey, how awesome for them. I'd like to do that. And then the Farm Credit Funding Corporation then divvies it up across 4 banks and says, hey, I got some money for you. And they then turn around and accept loan applications. Who is the person that is asking for credit? These are the member borrowers, as they are called. These could be farms, these could be co-ops, these could be equipment loans, operating loans. These could be, in some cases, home loans for the farmers for specific purposes. And all of this has some congressional oversight over it. This is not an institution of the government. However, the government does have some oversight, and that is why it's rated very, very highly. The odds of the government just sitting there and watching the FFCB go upside down are slim to none, but they explicitly state that they are not part of the government. Having said that, obviously the members eventually pay back the loan and they pay interest. Then the Farm Credit Association gives that coupon back to the bank. The bank gives it back to the Farm Credit Funding Corporation. They give it back to the dealer. They keep another cent on the dollar. Great business. And then the dealers give you and I the coupon state tax free. And that is really how the money flows there. So having said that, let's look at how this money actually flows. When you and I go there, and if we take a short-term, FFCB bond, for example, 9 months, a year, year and a half, something like that, it pays about 5.7% plus your state tax break, which in Illinois is 6%. So give or take 6%, which is fantastic. And we're like, woohoo, this looks awesome. By the time it goes through 5 different hoops and goes to the member, they get it for 8.25% today. And I actually called a couple of growers. I'm associated with the agricultural world in another hat I wear, and said, how much does an FFCB loan cost you for equipment, for operating loans? And some of them say, hey, we have really good credit. I haven't gotten an operating loan lately. However, I do get some equipment loans and they are term limited, and we pay 8.25%. And I was like, whoa, look at that. That's a pretty nice 25% markup as it passes through 4 hands in between. But hey, at the end of the day, we're helping our own country's farmers, so that's wonderful. And there is the money flow for FFCB. Then you say, what else is going on in the world? And you kind of make a note that, there's unfortunately, a trade war. China from 2018 until 2022 was buying more and more of US agricultural products, and that trend is decreasing pretty steadily. And because of the trade war, and the Chinese are saying, I'm not going to buy your stuff, guess what that does to the agriculture trade balance? Our trade balance is upside down. In other words, our imports continue to either go up or stay flat, but our exports, primarily driven by China, our exports are dramatically down, and so our trade balance is upside down. What does that mean? If you are a grower and you borrowed money from the FFCB saying, oh, I'm liking the trend of the past 4 years, 2018 through 2022, and I think China is going to keep buying more and more of our stuff, life is perfect, and I'm going to borrow more. Well, you have a little bit of a challenge the last 2.5 years. And if you have a variable rate loan, as interest rates went up, you're paying more in coupons. If your crop was historically sold to China, think pork, think soybeans, and the Chinese are buying less from the United States, you are getting hurt because your price is falling. And also, if unfortunately your farm was in one of the natural disasters, maybe you were growing pineapples in Mali, or maybe you had an orange orchard near Jacksonville, and then those folks have suffered there. And so there are a lot of reasons why there is an issue with the growing community. And therefore, what does it mean to the FFCB loans? And here is the interesting thing that happened. The non-performing loans, meaning loans that were borrowed but it couldn't be paid back, started dropping more and more and more because interest rates were really low. And as interest rates started moving higher and higher, non-performing loans are also going up higher. And as a matter of fact, they have reached pre-COVID levels and are trending in the wrong direction. So what does that mean? Should we panic? Should we not panic? I'll save you the suspense. High yield bonds, and some of you, even though you think you own investment grade bond ETFs, I challenge you to go read the prospectus and to kind of spice up the dividends of investment grade bonds, ETFs. And this is a true statement. You go read. The bond manager has the discretion to mix in anywhere from 5 to 15% of non-investment grade bonds to make the number bigger. And that is how people fall for investment grade bond ETFs. And I don't mean to say anything negative about all investment grade bond ETFs, and I'm sure there are wonderful ones and not my cup of tea, but you do you. But high yield bonds, these fail at a rate of 7%. Farm credit is barely at 0.7%. So it's nothing to write home about and say, oh my God, we don't, But at the same time, if you want to be a little smart, I wouldn't buy 10-year FFCB bonds. They're callable anyway. 2 years, 3 years, something like that sounds like a no-brainer to me. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.